The difference between US GAAP and IFRS. Understanding these two financial reporting standards is crucial for accountant, auditor, and investor. Companies expanding globally must comply with different financial reporting regulations, making it essential to know the key difference and similarity between US GAAP and IFRS. By the end of this season, you will have a clear understanding of the fundamental difference between these two frameworks, why they matter, and how they impact financial statement and business decisions. What are US GAAP and IFRS? What is US GAAP? US GAAP stands for Generally Accepted Accounting Principle and is the accounting framework used in the United States. It is developed and maintained by the Financial Accounting Standards Board and overseen by the US Securities and Exchange Commission. It follows a rule-based approach, meaning it has detailed specification guidelines for recognizing and reporting financial transactions. What is IFRS? IFRS stands for International Financial Reporting Standards. It is the global accounting framework used in over 140 countries. It is developed and maintained by the International Accounting Standards Board. Unlike US GAAP, IFRS follows a principle-based approach, meaning it provides general guidelines rather than strict rules, allowing accountants to apply professional judgment. Key difference in approach: US GAAP is rule-based, meaning it is focused on detailed prospective rule for financial reporting. IFRS is principle-based, meaning it provides broad guidelines and relies on accountants' interpretation. Example: in revenue recognition, US GAAP provides extensive specific rules while IFRS offers general principles, giving companies more flexibility in applying judgment. Key difference between US GAAP and IFRS: inventory valuation allows LIFO and FIFO. Under IFRS, companies can use fair value accounting for asset-light building and equipment, but US GAAP generally require historical cost. Financial statement presentation: US companies follow GAAP must prepare 4 primary financial statements. Number 1, balance sheet. Number 2, income statement. Number 3, statement of cash flow. Number 4, statement of shareholder equity. IFRS requires the same but with different format and terminology. For example, under IFRS, a balance sheet is called a statement of financial position. Revenue recognition example: suppose a company receive advance payment for service to be delivered over 12 months. Under US GAAP, revenue is recognized in strict accordance with ASC 606 rule. Under IFRS, the company has more flexibility in recognizing revenue over the contract period. Inventory valuation difference: a retail company in the US may choose LIFO for tax advantage. Under US GAAP, if the same company expands to Europe, it must switch to FIFO because IFRS does not allow LIFO. Comment below and tell me which GAAP you like. Keep hustling and keep moving.